Hey there, finance friends. Welcome back. So, we've been taking a bit of a journey through taxes, and I know it can be a combination of simple but also complex and a lot of jargon and a lot of papers and schedules and forms. And that's okay, that's normal. Just kind of absorb yourself in it, be comfortable with the jargon. You'll get through it no problem. The big picture that we've said so far, though, include the following. We've said number one, so far we've learned that number one, we have a system based on marginal tax rates. We know that your marginal tax rate is determined by your taxable income. So your taxable income is the basis for your tax rate and therefore your total tax burden. So we learned number one, marginal tax rates in a progressive system. So the more you earn, the higher your bracket is, the more tax you pay. Number two, we learned that your taxable income is the basis for your tax rate. The third thing that we learned is that your taxable income is not the same as your total income. In other words, we learned you do not pay tax on every dollar you earn. And then the last thing we did in our last video, we put all that together and we learned that deductions reduce taxable income. We learned especially that your total income minus your above the line deductions equals your AGI, which minus either your itemized or your standard deduction. We're going to take the bigger one, right? Itemized or standard. That is going to lead to your taxable income. And there's a lot of conclusions in here. The primary one being, if we want to reduce our taxes, we increase legally our deductions. We're aggressive in our knowledge. We learn the tax code, or we get a good advisor who can help us, and we take advantage of everything we can do. We plan. We don't just take out student debt or mortgages just because. We don't just put money into an IRA just because. We make our plans and we take deliberate action knowing that those are going to have impacts on this setup. So that's the basics right there. And even with that, you've got a lot of good knowledge. And when we're in class together, we'll put some numbers behind this. In this last lecture, what I want to do is I want to talk about a couple of advanced tax strategies. Obviously, it is really important to maximize your deductions and to be smart about it. Okay. To know all the options available, to be a student, not in depth like you're a tax pro, but to be a student of taxes, because again, the less you pay to the government, the more you keep for you and future you. Okay. That's important. Okay. But now we can talk about a few advanced strategies. So let's talk about a couple of things. Advanced strategy number one, take advantage of 401k or 403b plans. In our previous set of lectures, last time we met, we talked about retirement planning. And we learned that 401k and 403b plans are retirement plans specifically offered by your employer, okay? Those are offered by your employer. Those are what we called employer-sponsored plans. And we talked about those, and I said to you, these are like awesome. And I said they're like a triple win. And I said that one of the wins was that you got the match. Remember the free money match? Awesome. And we also said that as long as that money's in the bucket, the tax benefited bucket, the tax advantaged account, it's going to grow tax free. And when your money grows tax free, that's basically deferring. You're not paying any money. You're not paying any taxes on any of the capital gains or interest or dividends on the stuff that's in your 403B or 401k bucket. And therefore, by deferring taxes, we know our feedback loops, we know our leakages. By deferring taxes, we maximize compounding. Pretty badass. I like it. That's two awesome things. Defer taxes till later, get free money now, get the full compounding. Remember we talked about DRIP, we talked about the DRIP strategy. We're going to reinvest those things. This is great. But I left out one important thing, and here's the real money maker. 401k and 403b plans reduce your taxes now. And here's the reason why. If you look right here on this tax return, we opened up with the idea of box 1. This is your wages. 1A, the total amount from form W-2. Your W-2 form, that's the form that you get if you're an employee from your boss that tells how much money you earned. So LMU gives me a W-2, it's got my income on it, and I transfer that income right here to line 1A. And then, of course, we said, yep, so I take that income from LMU, and then I add it to my other income to get my total. Then I do my above the line. I get my AGI. I do my standard deduction. I get my taxable income. We learned this in the last video. But I left one important thing off because we just started right here. This is the number that comes from your W-2. But look at the skeleton. We started right here on the tax return, but look at the top part. Here's the thing. On box 1A, we put our taxable wages, but not our total compensation. Because get this, look, it's amazing. There's an adjustment up on top, which I didn't talk about in the last video. This is the 401k, 403b deduction. Your total compensation is what your boss actually pays you. You get to deduct from that the amount, we call it pre-tax contributions. You get to deduct from that the amount that you put into your 401k. So technically speaking, let's just say that I earn $100,000. Let's just say that's my total pay. Let's say that I put $25,000 into my 403b. Let's say I put a couple grand every check. So I put $25,000 into my 403b retirement plan. This is good news. Okay, remember our systems, right? We have our income and we send some to obligations and some to luxuries and some to savings and investment. And we know that this is the money. We have the cash. We invest it. That generates cash. And then that was our feedback loop. Okay, really good stuff. But notice a little subtlety here. The money that I contribute, so part of my savings and investment is my 403b. I don't pay taxes on it today. I don't pay tax on it until years in the future when I pull the money out when I'm retired. Here's how it works. Suppose that LMU pays me $100,000 total, but suppose that I put 25,000 into my 403B retirement plan? Because that money is taken away from me before I touch it. Because it's siphoned into my 403B plan and invested before I even touch it, it's not counted as my income. So it looks like this. This number here that is reported on box 1, which corresponds to what we had right here, this is not what you actually make. It's amazing. This whole thing here was to show that you're not taxed on every dollar you make. And we took total income and we chipped it away. But it gets even deeper. The amount that you report as total income isn't even necessarily what you actually earned. So technically, the amount that you earn is reduced immediately by the amount that you set aside for future you. Think about this. You take care of future you, and today you, current you, gets an automatic tax benefit. Awesome. Awesome. This $75,000 in turn, this is then reduced by your above the line deductions. And this is what gives you your AGI. And then from there, that's reduced by your standard or itemized deduction. And this is what gives you your taxable income. So now think about this. You can take the amount that you put into your retirement plan plus any above the line plus your standard or itemized. It's very easy. I mean, look at this. If I put $25,000 in to my retirement plan and I take my standard deduction of $16,100, I'm reducing my income, I'm reducing my taxable income immediately by $41,000. Well, you know how it works. $41,000 times whatever your marginal tax rate is, that's your tax savings. Think about this. Let's say that I'm in the 22% tax bracket. If I put $25,000 into my 403B, that's going to compound for decades, and future Eric will love the compounding. But present Eric also saves money. If I'm in the 28% tax bracket, I multiply my contribution by 28%, and that's actually the money that I save right now. Where else could you get free money, current tax savings, full compounding, and deferred taxes? These things right here, my friends, they're widely misunderstood, the 401k and 403b, but they're your best friend in finance, because almost every single thing that we talk about, cash flow, it affects it. Retirement, it affects it. Tax planning, it affects it. So advanced strategy number 1, maximize that 403b or 401k contribution. Advanced strategy number 2, avoid short-term capital gains. Capital gains are when you sell an asset. Okay, so technically speaking, your capital gain is equal let's say that you have stock. Let's say that you bought some stock and then later on you sell it. The revenue that you get from selling it, the price that you sold it at, minus what you paid for it, is your capital gain. Okay, so your capital gain, not hard. It's just the difference between how much you paid for something when you bought it and then what you sold it for later. It's a capital gain. Critically, capital gains are income. And as income, you know where this is going. It's going to be taxed. Specifically, look right here at line 7. There it is. Capital gain. Any capital gains that you make, you're going to put in there and it's income and you're going to be taxed on it. Now, I know that some of you might be thinking politically, this is stupid. I already paid tax on it when I earned it. But again, I don't disagree with you, but that's a political issue. And we're going to focus here on understanding the game, the way the game is written. Okay. But here's one thing. In our opening lecture, way back when on taxes, several lecture videos ago, we said not all income is taxed the same, right? Well, check this out. Long-term capital gains are income. They're going to be reported there. But there's something very interesting. Capital gains can be classified as either short-term or long-term. A short-term capital gain means that you held the asset for less than 1 year. So if you buy a share of Tesla stock and then you sell it less than a year later, the gain that you make is a short-term capital gain. Short-term capital gains are taxed at whatever rate you're in. So if I, for example, I'm in the 22% bracket and I make $10,000 on a short-term sale of Tesla stock, that $10,000 is going to be taxed at 22%. 2,200 goes bye-bye. Well, 2,200 federal goes bye-bye. And then, of course, we know that I'm also going to be paying, where am I at here? 9.3 state. So 22 federal plus 9.3 state is about 31%. So yeah, if I make $10,000 in a capital gain, 31% is going bye-bye. I'm only keeping 69%, 6,900. That's not kind of cool. But that's for short-term gains. Let's talk about long-term capital gains. A long-term capital gain occurs when you sell an asset that you have held more than 1 year. And this is crucial because long-term capital gains have preferential tax rates. In fact, it's right here. It's right here. It's right here. It's right somewhere. Yeah, it's right here. This is for 2026. Check this out. Let's say that you're single. So I'm single. So this is me right here. If my income is between be real precise here. I'm single. If my taxable income is from 0 to 49,450, I pay 0% capital gain tax. Say, what? Yeah, I know. So you're saying, Eric, if your income is above 0 but below 49,450, if you're in this range, you pay 0 taxes on long-term capital gains? That is correct, Buttercup. You heard me right. let's say that my taxable income is 100,000. That puts me in this range here between 49,450 and 545. 15%. So think about it. If I were playing and I had a short-term capital gain, I'm paying 22%. If I can just wait to get through the 1-year threshold, I'm only paying 15%. And now check this out. If your income is greater than 545,000, so clearly you're making a lot of money. But let's just play this out. If you're making 545,000 or so and you're single, you're probably paying anywhere from 35 to the 37% bracket on a short-term gain. Hold that for 1 year, 20%. Again, you might say that this is wrong, it's morally unjust, but again, that's not our case here. We're not saying that here. This is the way the game is written. If you sell stock or any asset in less than a year, you're going to get crushed on your taxes. If you can hold that asset and sell it as a long-term capital gain, you're going to get a preferential rate. You're going to pay less tax. You're going to keep more cash flow. Okay? So strategy number 2, take advantage of long-term capital gains. I do want to point one important thing out. This only ties in to non-tax advantaged accounts. It's very important that we bring this up. In other words, these rules here only count for regular brokerage accounts. Because remember, if you have money in your retirement plan bucket, that money is growing tax-free anyway. So the capital gain rules that benefit long-term capital gains are only for assets that are not sitting in retirement plans. So bear that in mind. And then the third oh, and by the way, this should also tell you, when we say avoid short-term capital gains, this should be a little bit of a hint as to why day trading for most investors is a bad strategy. The main reason why so many day traders underperform the market, we talked before about the market and the benchmarks. The main reason why so many day traders underperform the market is not just an issue of trying to time the market, but it's an issue that because they're buying and selling very quickly, any capital gains that they make are being taxed at their regular marginal tax rate. Because they're buying and selling on a short-term basis as day traders, they can never avail themselves of those preferential long-term rates. So if you think about that, if you're day trading, you got to consider this stuff, okay? The final strategy is to take advantage of tax credits. We've been talking about tax deductions, okay? We've been talking about tax deductions. A tax credit is not a deduction. They're different. Specifically, a tax deduction, as we learned already, reduces your taxable income. Specifically, on a dollar-for-dollar basis. We already learned this. We have total income minus our deductions above the line and below the line equals our taxable income. So obviously our deductions fit right there, and they reduce our taxable income. So what do credits do? Well, here's what credits do. Remember, once we had our taxable income, we were then able, based on our taxable income, our filing status, and our marginal rate, to get our tax burden, our tax liability. Credits reduce that. So your tax burden minus any tax credits equals your final tax burden. Now you can make the argument that credits and deductions are both similar in that they reduce your taxes. You're totally right. But here's the difference. The deductions, they fit right here, reducing your taxable income. Credits, on the other hand, kick in way down here. Credits reduce your tax liability on a dollar for dollar basis. They're both great, but if you have a choice, you always take the credit because, again, this deduction will only reduce your taxable income, thus reducing taxes by your marginal rate. Credits reduce your tax by the full dollar. To put this in our forms, jumping to the very bottom, we had here taxable income. And then from there, we got it says tax, but it really means initial tax. Then we get credits, and other credits, and those reduce so that our total tax, our line 24, is less than our initial tax, line 16. So credits are the final little cherry on the cake. Once you've gotten your taxable income as low as possible, gotten those taxes down as low as possible, then if you have credits, it pulls them down even farther. Okay, so that's what credits do. You can see on the tax skeleton, we went from income to AGI to taxable income to what I called initial tax liability. And then we subtract our credits to get our final tax. So those are 3 advanced strategies. Retirement plan, maximize them. Okay? Capital gains, make them long-term, and be wise about your purchases and about your tax decisions. Understand the tax code so that you can potentially take advantage of tax credits. You do all these things together, my friends, and you will be able to achieve legally our primary goals of reducing, deferring, or eliminating taxes, thus paying less to the government, increasing your own net income, and having more money available for current you and for future you. Okay, that's our tax lecture. When we meet together, we'll do some numbers to sit behind this, and then time permitting, I've got some mock-up W-2s and other forms. We'll do a little mock-up tax return so we can take all these concepts and put them into practice, okay? This is some tedious stuff. Thanks for sticking with it. I'm proud of you, and I will see you in our next set of videos. Have a good night and take care.